Every recession has a villain, not a metaphorical villain, not a vague sense of economic malaise that showed up uninvited, a specific, identifiable structural villain, a thing, a product, a system, a bet that got too big and too fragile and then collapsed under its own weight and took everything around it down on the way. In 2000, the villain was the dot-com bubble. Companies with no revenue, no customers, and no business model were trading at valuations that assumed the internet would replace every human activity within 5 years. When reality showed up, the Nasdaq lost 78% of its value. It took 15 years to fully recover. In 2008, the villain had a name: mortgage-backed securities. Banks took millions of bad home loans, sliced them into complex financial products, stamped a AAA rating on them, and sold them to every pension fund, sovereign wealth fund, and institutional investor on the planet. When the housing market cracked, the entire global financial system cracked with it. 8 million jobs, 6 million foreclosures, the worst economic collapse since the Great Depression. 2 recessions, 2 distinct villains, 2 very different mechanisms. But both had one thing in common. In hindsight, the warning signs were obvious. The numbers were there. The leverage was visible if you looked. The incentives were clearly misaligned. People just chose not to look because looking was inconvenient and the party was still going. Which brings us to today. Because right now, hiding in the part of the financial system that gets the least press coverage and the least regulatory scrutiny, there is a $1.7 trillion market that barely existed 15 years ago. It has grown at nearly 20% per year for the last decade. It is almost entirely unregulated compared to traditional banking. It operates with almost no transparency. And it is now deeply embedded in the balance sheets of companies, pension funds, and institutional portfolios across the globe. It's called private credit, and it might be the villain nobody is talking about. Let's back up and explain what private credit actually is, because most people have never heard of it. And that's exactly the problem. Traditional lending works like this. A company needs money. It goes to a bank. The bank evaluates the risk, issues a loan, and holds that loan on its books or sells it to the public markets where it gets priced and traded and scrutinized every single day. There's transparency, there's price discovery, there's a visible market signal when something starts going wrong. Private credit is different. In private credit, the lender isn't a bank, it's a private fund, usually run by one of the big alternative asset managers. Think the giant firms that manage hundreds of billions in assets across real estate, infrastructure, and now lending. These funds raise money from pension funds, endowments, sovereign wealth funds, and ultra-high net worth investors. They deploy that money as loans directly to companies, mostly mid-sized businesses that can't access the public bond markets easily. The loan never gets listed, it never gets traded, it sits on the fund's books, valued not by the market but by the fund's own internal models. Read that last part again. The value of the loan is determined by the people who made the loan. Now here's the thing. In good times, private credit looks like a genius product. The loans pay higher interest rates than public bonds because they're less liquid and harder to get. Investors get yield. Borrowers get flexible capital without the hassle of public markets. The fund managers collect fat fees. Everyone's happy. The market grows from $400 billion in 2015 to over $1.7 trillion by 2024. It's a feedback loop that's beautiful right up until it isn't. And here's where the mechanism starts to crack, because private credit funds don't mark their loans to market the way public funds do. When a publicly traded bond starts deteriorating, the price drops in real time. Every investor can see it. The signal is immediate. In private credit, the loan gets marked quarterly by internal models, using assumptions the fund itself controls. This means stress can build up inside these portfolios for months, sometimes longer, before it ever becomes visible to the outside world. It's the financial equivalent of a check engine light that only turns on after the engine has already seized. And now layer in the borrowers. The companies taking out these private credit loans are mostly mid-market businesses, companies generating somewhere between $10 million and $1 billion in revenue. Many of them took on this debt during the near-zero interest rate environment of 2020 and 2021, when borrowing was essentially free. But private credit loans are typically floating rate. That means when interest rates go up, the interest payments on these loans go up automatically. The Federal Reserve hiked rates from near zero to over 5% between 2022 and 2024. For a company that borrowed $50 million at 6% interest, a rate environment shift to 11% or 12% all-in borrowing cost isn't an inconvenience. It's an existential threat. Meet a company we'll call Apex Manufacturing. Apex makes industrial components, solid business, predictable cash flows. In 2021, Apex borrows $40 million from a private credit fund to finance an acquisition. The interest rate is floating, tied to a benchmark plus a spread. At the time, total cost of borrowing, roughly 5.5% annually. That's $2.2 million a year in interest. Manageable. By 2023, with rates elevated, that same loan is costing Apex closer to 11%. That's $4.4 million a year. Double. Apex's operating cash flow hasn't doubled. Apex is now spending a much larger share of every dollar it earns just servicing debt it took on when money was basically free. Multiply Apex by thousands of mid-market companies across the economy. That's the exposure. And here's the historical rhyme, because there always is one. In the late 1980s, the leveraged buyout boom created a nearly identical setup. Private equity firms loaded companies with debt, interest rates were high, and when the economy slowed in 1990, a wave of defaults hit the junk bond market. The firm at the center of it, Drexel Burnham Lambert, collapsed. The junk bond market froze. Credit tightened across the entire economy. Hundreds of companies that had nothing to do with junk bonds couldn't get financing because the shock rippled outward. Sound familiar? It should. The difference today is scale. The private credit market of 2024 is roughly 4 times larger than the entire junk bond market was at the peak of the 1980s boom, adjusted for the size of the economy. And unlike the junk bond market, which was publicly traded and therefore visible, private credit sits in the dark. But the problem isn't just private credit in isolation. That's only one piece of the picture, because the consumer side of the economy is carrying its own time bomb. Total U.S. consumer debt just crossed $17.5 trillion. Credit card balances hit a record $1.13 trillion in 2024. The average credit card interest rate is sitting above 21%, the highest it has been in the history of modern consumer credit tracking. Americans are carrying more high-interest revolving debt than at any previous point in recorded financial history. And the delinquency rate on credit cards has been climbing steadily since 2022, now back above pre-pandemic levels and still rising. This is not the debt profile of an economy with shock absorbers. This is the debt profile of an economy where a moderate unemployment spike doesn't just slow spending. It triggers a cascade. People lose jobs. They can't service the credit card debt. Delinquencies spike. Banks tighten credit. Spending drops. Companies see revenue fall. Layoffs accelerate. The feedback loop runs in reverse. And here's the uncomfortable truth. The reason the next recession will hit differently isn't just because of private credit or consumer debt in isolation. It's because of the combination. It's because the two pressure points, over-leveraged mid-market companies in an opaque lending market and over-leveraged consumers in a high-rate environment, are sitting on top of each other like tectonic plates. And when one moves, the other moves with it. Because when companies start defaulting on private credit loans, the pension funds and endowments holding those loans take losses. Those institutions become more conservative. They pull back from other investments. Markets feel the pressure. Consumer confidence drops. Spending slows. And suddenly that 21% credit card balance that was manageable on a steady income becomes unmanageable on an income that just got disrupted. The 2008 crisis was fast and visible. The mortgage market cracked, and the damage spread in real time across public markets. Everyone could see the numbers moving. This time, the damage could build slowly and invisibly inside private portfolios for quarters before it surfaces. And by the time it shows up, the hole may be much larger than anyone modeled. So what does this mean practically? Here's the short version. First, understand that diversification into private assets is not the same as safety. If your pension, your endowment, or your retirement portfolio has exposure to private credit funds, you may be carrying risk you cannot see. priced by models you cannot audit. Second, consumer debt at 21% interest is not a holding pattern. It is a slow bleed. The single highest return financial move most Americans can make right now is paying down high-interest revolving debt. It is a guaranteed 21% return. Nothing in the public markets offers that risk-adjusted. Third, the next recession's early warning signs won't come from the stock market. They'll come from private credit default rates, mid-market company distress signals, and consumer delinquency data. Watch those numbers, not the headline index levels. Fourth, companies that survived 2020 and 2021 by loading up on cheap floating rate debt are not the same companies they were before. The balance sheet risk is real. Sector exposure matters more than it did 5 years ago. Now here's where I want to know where you land, because after walking through all of this, there are really only 3 positions. Option A. You think private credit and consumer debt are manageable risks and the economy has enough resilience to absorb a slowdown without a systemic crisis. Option B. You think the opacity and scale of private credit combined with record consumer debt makes the next downturn structurally more dangerous than 2008. Option C. You think recessions are impossible to predict. All of this is noise, and the only move is to stay invested and ignore the macro entirely. Drop your take in the comments, because the split on this one is going to be interesting. Because here's the thing about financial villains. They're never obvious until after they've already done the damage. And right now, the most dangerous one isn't on the front page. It's sitting quietly in a quarterly report that nobody is reading.